Hi, and welcome back. Thank you for joining us at PSA, People, Stories, and Accounting. I'm Yaacov Jacob,
And I'm Philip Stein.
and today we are going to get into founders, high-tech firms, where to incorporate how it changes now with the one big beautiful bill that passed just a couple weeks ago.
Yeah, I think particularly I think it's really an exciting development. It's not something that's been super publicized, but I think for people who are listening to this, anyone who is considering a startup or someone who's considering Aliyah and they want to incorporate before they come here, this has a lot of potential upside. So let me give you the background, the initials that Yaacov is referring to, or what's referred in the professional parlance as QSBS, which stands for Qualified Small Business Stock. It's really something that the Congress, the Internal Revenue, had struggled for a few years to sort of incentivize corporations, not service corporations, but corporations that really create something, particularly in technology. And you can actually have an exit if you're lucky enough to get to that stage and pay little or no tax. So we'll go into the details of it in a few minutes, but what the people who should be paying attention to this section of our talk today are people who are thinking, where should I incorporate? I've got an idea. Should I incorporate in Israel? Should I incorporate in a third country, or should I incorporate in the United States? And very often people say, well, I'm in Israel. Why should I incorporate in the US? The big tax advantage, which Yaacov will go into, is that one, you may be in Israel today, and you may be an Israeli today, but if you relocate at the time and you're living in the US at the time of the exit, if you chose this to be a QSBS and you can qualify, you may pay no tax. If you are coming on Aliyah, and even if you go beyond even if you're within your 10-year tax holiday, you might be able to have an exit and not pay any U.S. tax. So these are big benefits, and Congress has actually raised the ceiling on this, which Yaakov is going to explain what all of this means. So go ahead, Yaakov.
Yeah, and I think also we've had a lot of employees who have stock options and the like from these high-tech companies. When they are based as a US company first, that can really give those employees some big benefits as well. And I think, Philip, over the years, we've seen kind of a shift, right, of people opening sometimes US parent company, Israeli subsidiary. Sometimes throughout the tax laws, as they change, it makes more sense to do the opposite and have an Israeli parent, US subsidiary. Now, over the past couple of years since TCJA of 2017, we've kind of seen it kind of shifting back. And this is going to, I think, really boost that even further and even more, so that people are going to really want to be opening up US parent companies, Israeli subsidiaries, in order to kind of have that relationship there. And that's really cool. Meaning, and I think it also drives home what the effect that President Trump was trying to get across was that they want people to really have the main company in the US to start building more in the US itself and incorporating there and the like. So I think it does accomplish those goals that they set out to achieve. The big benefit now from QSBS, or Qualified Small Business Stock, otherwise also sometimes called 1202 from a code section perspective, is that it used to always be a $10 million cap, right? If you were to
Right.
sell your company and have capital gains of $10 million, there was some hard cut lines. Number one, it was that $10 million cap. Number two, you had to have held on to it for at least 5 years. And it was, if you held on to it for 4 years, 11 months, you wouldn't qualify. If you held on to it for five
Right.
years, then you would get the green light. And it kind of caused a lot of mayhem and problems in terms of merger and acquisitions, in terms of purchases of companies, secondary rounds, and the like. I don't know. I mean, how many times have we seen this? We've seen plenty of times, right, where people will come to us and they'll be on the almost edge of an acquisition or
Right.
something like
Right.
that. And the first questions that come up are, well, where is it incorporated? How much percentage do you hold? Right? I mean, how many times would you say that comes up on a regular basis?
All the time, all the time. And I think listen, if someone says to me they have a startup, how long till I exit? It's 7, 8, 9, 10 years is not unusual. But we have seen, Yaakov, cases recently, particularly in cyber AI. In other words, the
Yeah.
exits are much shorter. So what you're saying is that Congress has realized this and is now lowering, you can get some of this benefit even if you don't hold the stock for 5 years.
Yeah, it's a big deal. Meaning, I think with the verge of vibe coding and everything else going on now, we've seen some people have single year sales, right? Where they will start something, not write any real code themselves,
Right.
have AI generate all the code, and they can sell it for $80 million, within the same year, within 1 year of opening up that company. You have companies, we've dealt with clients recently who moved to New York for founding a company that they had, right? It was there maybe 2, 3 years ago, and with everything going on these days, it was a big acquisition for hundreds of millions of dollars that they sold their company for, and we had to kind of go into it with them, and they did not qualify for qualified small business stock because it was within the 5 years of opening it up. But what this really does is it allows proportional amounts. So you have a gap for
Yeah.
3 years. After 3 years, 50% of your gain can be excluded. After 4 years, 75% of the gain can be excluded, and after 5 years, 100% of your gain can be excluded, meaning that you are totally exempt for U.S. capital gain tax on those sales. And that comes in big for a couple of reasons that it can really, really help. But that means that if you are holding a company for over 3 years already, and you have this opportunity for a secondary round for the ability to sell some of your shares, or you are going to sell it to some of the bigger places that we've seen for our clients having their company sold to, you will qualify for 50% of that acquisition price up to $15 million now, as opposed to the lower 10. You
Wow.
can totally exempt. So that's a big, big deal. That is a big win for people that we've had.
I also want to add two other interesting things to think about. Again, if I'm the our Israeli client who's saying, "Well, I don't think I'll ever relocate. I don't think it really be relevant." But if you're raising money, your investors can also take advantage of this, and they have not only, as you refer to, Yaacov, this 15-minute sailing, but they have a 10 times their investment
Oh,
that's
50.
also in there. So
Sure.
if you're looking at some point, even if you're not going to relocate, but your money, some of your investors, this makes you a much more attractive investment being a US corp. So I would say that. And I think also it's gone back and forth in the old days when, I'd call it the dot-com era. People didn't feel confident to invest in an Israeli company, so you had to go with the US. Then it shifted away from that. But I think today most of the people we're seeing, I think because of QSBS and because there are gaps in the treaty, Yaakov, which you know very well. And as I always say, when this treaty was first negotiated, or most of it was negotiated in the 70s and early 80s, no one envisioned an Israeli starting a company, moving to California, and having an exit. The treaty just couldn't imagine. It's almost like you and I may be talking about having a startup on the moon. Okay, how
Yeah.
would the tax be treated? So there are gaps, and this really can take away some of that uncertainty and some of those exposure to double taxation. So I think it's really exciting. I think if you're in high tech, if you're entrepreneurial, call Yaakov and ask him more about this because it's something you should be really aware.
Philip, if you remember, I was talking to you just the other week. We had a client who recently sold his part of his startup, right? And
Right,
because he was in the U.S. with U.S. income as well as this capital gain, he was able to, even though he was able to source it as a foreign capital gain, he still got hit with high taxes because while he was paying 30% in Israel, and you think that that would cover the 20%
right,
long-term capital gain rates in the U.S., the problem was that there's a that when it comes to the foreign tax credits, there's a clause in there that
right,
basically changes the tax rate on those long-term capital gains for foreign taxes, and you don't really get the full benefit. So
correct.
also, if this was something that was a U.S. company qualified for QSBS, he would be paying nothing on it, and instead he ended up paying, even though he's paying 30% in Israel, he still ended up paying a nice amount to the U.S. as well.
This is a great solution, and it's interesting to me that President Trump and Congress, I think it really shows what his ambitions are in terms of bringing investment into the U.S. and having U.S. corporations sort of be leaders, or at least structurally, in technology. All right, let's move on. I know we wanted to talk about estate
Right.
and gift. So
Yeah. So absolutely. Do you want to tell people a little bit about what the estate exemption was until now? What the estate tax is, how it works?
Yeah, in other words, people, U.S. citizens, we can talk about non-U.S., but let's just focus on U.S. citizens, U.S. tax residents. After you've paid all your income tax, unfortunately, in the United States, there is a tax on the value of your estate, what you own when you die. Now, most people, hardly anyone pays this anymore, okay? And the reason is that over probably the last 25 years, the exemption from estate tax keeps growing. There was some fear that it was going to revert, but even then, if Trump hadn't extended these exemptions, it would still be for a married couple filing, well, not filing joint, but a married couple, probably somewhere in the 13, 14, $15 million for a couple, which I
Right.
think most people, but there are people, and you mentioned it last week, if you have real estate in Israel, people who inherit money from a previous generation, you can get up to these numbers. So what Congress did is they basically not only left the exemption intact, they kicked it up a little. They continue to index to inflation. So we're talking about, and if someone dies after December 31st, 2025, an individual will have a $15 million exemption, and a couple 30 million, which will be indexed.
Crazy.
So that takes a lot of people out of the estate tax world. I will mention parenthetically that if you're not a U.S. person, meaning U.S. citizen or resident, these exemptions do not apply to you. You don't vote, so you don't affect Congress, and they have left the exemption for non-U.S. persons on U.S. property at only 60,000. But we're not going to talk about that
That's
today.
pretty crazy.
We will talk it on a future episode of how people can deal with that. But this does lead people to, in earlier phases of this exemption, they may have thought they were gifting the maximum, and now they have more to give. Maybe you can talk about that, Yaacov. And just in terms of the sort of interplay between gifting and taking advantage of the exemption of when
Yeah,
someone
and I
dies.
think that's kind of there's a nice hot take here where I think it isn't by accident that you have this SBS limit being $15 million now, and the estate limit also bumping up to $15 million. And part of the reason there is that there are some tools using trusts and gifting that you can do in order to duplicate those QSBS exemptions. And so there is a possibility in a crazy world where you can split a gift with your spouse into two different trusts, right? Where you could potentially have 15 million going from you, $15 million going from your spouse, and you are holding $15 million of that founding company that was a U.S. Incorporated company that you hold, and then you can have a sale of up to $45 million entirely that is exempt from U.S. capital gains tax. That's massive, and so the
It's
ability of what you're
interesting.
able to
You
do.
last week mentioned the use of trust because of the state tax that you could actually maximize. So now it's sort of a additional advertisement for trusts,
Yeah,
both for QSBS and for estate. So I guess my take, based on what you're saying, is trusts are still, even with these exemptions, trusts are still something one should look at, especially if you're in the ultra high net worth.
absolutely.
And they can be beneficial from what you mentioned last week, state tax. Now you're saying estate tax, and now you're adding in QSBS. So that's a very important takeaway.
Yeah, if you are absolutely, if you have these founder shares as well, you think that your high tech firm is really going to take off. They are a great asset to put into an estate and get out of your personal estate, so that if you were to pass away, you don't then have all of this tax of a 40% tax leaning on your assets. You get it into that trust. It could be for the benefit of your kids, your spouse, whoever, and that's another way of just spreading that generational wealth. They are one of the best assets that you could possibly move into a trust, especially because they start off low value and can really shoot up.
Great idea.
So
All
yeah,
right, we're going to move on to an area that I'm going to throw at you. I know it was something that was in the one beautiful bill, one
yep,
big beautiful bill about R&D expensing. Can you share again? This
yes.
would be more for our, again, entrepreneurs or people who have their corps, particularly in the area of high tech and doing R&D.
Absolutely. There's a lot of R&D that goes in. Israel is a high-tech market first. It's big. There's so much R&D that goes into things. We've had it until now where basically US R&D for 2024 and before was you were able to depreciate it and take an expense over 5 years rather in the US, right? Foreign R&D has been 15 years. So now all of a sudden they are bringing back full immediate depreciation for U.S. R&D, and this is going to play another big part in terms of U.S. company, Israeli company, right? Where do you incorporate first? What should the parent company be? This is another big push for U.S. because here, if it is a U.S. company that has those R&D expenses, you can accelerate that expensing all to be within the first year. So
Wow.
that will be a huge benefit for you. Where if it's in the Israeli company, you're going to have to amortize it over 15 years and take it as a 15-year expense smoothed out over time. So it's a big boost for the US. It is an adjustment. There's also some other nice things that they've done there where they didn't make it retroactive. So if you still haven't filed 2024, you still have to take, the 5-year approach. But for
Right.
2025 onwards, they did say if you have any of that back expense is still around from 2024 or prior, you can accelerate all of that expensing in the beginning of 2025. So anything you do have left over, 2025 will be a big year. Of course, you don't have to do that. You can choose to spread it out over 5 years, but they do allow you to do it so that this way you can take the full amount in that first year that you have those R&D expenses. It's going to be a huge benefit to companies starting bringing in revenue, wanting to keep income lower. Um, while keeping revenue high to get that acquisition.
But I just want to clarify because we've been really boosters this episode for incorporating in the U.S. But with regard to the R&D expensing and be able to get that benefit, it does have to take place in the U.S. In other words, it's you can't have that U.S. corp and then subcontract to your Israeli
Right.
subsidiary. Okay,
Correct. And what I believe, yeah, absolutely. Thank you.
okay. You got to plan to have operations there, and
And most
which
people do.
they do. Yeah.
What we'll see now, I think, is something that we've seen for a while, but even more now is that we have seen a flock of founders, executives moving, relocating to the US for a number of years, 2, 3, 5 years. People never want to say on record how many years they're specifically going for. I spoke to one person recently who was like, no, it's 3 years and that is it. I am not going to be there for longer than 3 years. My kids are joining the army. But for most people, they don't know if it's a life change, if they set out their plans, but there are a lot more people these days going to the US. I think with the war that opened up, it also kind of pushed some people to go there. All the more so, I think now we will continue to see lots of high tech executives, founders, and people going to the US at least temporarily, settling in different states in order to kind of play out what will happen. And so these will come in really, really handy. Being in the US will help with those R&D expenses and the like. All of that will come in very, very handy. And in fact, I will say that's the other thing I would bring up is that states definitely play a big part. Everything that we're saying now, QSBS, estate tax, R&D credits, all of that happen at the federal level. Different states will treat things very, very differently. So you definitely want to be in contact with us. You want to make sure that you are hitting the right state in order to kind of build out that company and maximize these expenses.
One thing I think that we want to start doing in our weekly episode is summarize what one move this week. Okay, I don't know if we'll call it one big move or one big beautiful move of the week, but we'll call it one move this week. What would be your move, Yaakov?
I mean, one big move I would say is if you're not sure where to incorporate your company, U.S. or Israel, the parent company, there are guiding lights here that clearly say do
Agree.
it in the U.S. You know, Another
Now,
one I would say is if you're not sure if you're going to open up your company, get in touch. Make sure that in some cases it might be better to open up an LLC that can convert to a C corporation, but for a lot of these reasons, it might make more sense to open up as a C corporation. So definitely decide on the structure and how to play it out. That would be my suggestion.
Now, I know when there was this period of uncertainty, certainly before the elections, was it going to be a Democratic president, Republican? And then even, how was the makeup of Congress? And different people had different concerns, particularly about the tax provisions that were ultimately extended a few weeks ago, or it's 2 weeks, almost 2 weeks now, less than 10 days ago. So, a lot of people had concern about the estate tax exemption. Other people, other aspects. You were particularly concerned about the corporate U.S. corporate tax going back up. Okay, right. That was something that as you referred back in 2017, we had to learn this whole area called GILTI, and we learned to live with it. And I give you credit, you were able to come up with some good strategies to beat GILTI, but your sort of box of tools would have been drastically reduced had the U.S. government raised the corporate tax back to 28, what was it, 35%.
Yeah.
So could you just share a little about the GILTI and where that is at after the
Yeah. And they actually also changed it in this one big beautiful bill. They did target guilty. They got rid of that acronym actually, which is one of the funniest pieces of it. They did
interesting?
get rid of that acronym. They changed it to tested CFC income,
Okay.
which I guess someone just didn't like the idea that it was being called guilty, although it
Okay.
was definitely clear when it was started. Yes, that is another big push for incorporating in the US first, right? You will have founders that are US founders with an Israeli parent company, US subsidiary, and it creates this big issue where you have this sandwich of US people on top and bottom, and then this Israeli company in the middle of that. Guilty is a big issue. I'm very happy that the corporate tax rate did not change. They did change the tax rates for guilty, so there's definitely a lot to be aware of there. You
Okay.
have to be paying a higher minimum of Israeli taxes than you used to be to get
Okay.
out of guilty tax, but there's a lot there to talk about and go over. It's a very complex situation, but I would say it definitely adds another big push to having a U.S. parent company, a Israeli subsidiary. Even though that will automatically somewhat put you in the guilty basket area, it still makes it much easier than the opposite with US investors and the like. Absolutely.
All right, so I think we've finished another episode. I know that there are people who do have questions, and some of these topics that you've touched upon are ones that, require further inquiry, and everyone has a little different situation. So, one, if people want to ask us questions, how would they do that, Yaakov?
Yeah, so they can get in touch with us at our website, www.philipstein or pstein.com, Pstein. You can find us there in the contact us section, and we're happy to help and be in touch. Thank you so much.
And we'll have another exciting episode coming up next week.
We got it. A hotly debated topic, I think, for next week of a big argument that I started online with people in terms of how the one big, beautiful bill actually shakes something out. So we'll see. Should
Oh,
be good.
cool. That's a nice teaser. So for PSA, I'm Philip Stein.
And I'm Yaakov Jacob. Thank you for joining us.